This webinar is proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.
Warren, as many of you know, is a trader. I asked him to do stop losses. And I know, when I was looking through the gallery at Just One Lap, there's a lot on stop loss. And I went through it and I was looking at what we got and everything. And it wasn't so much that I thought we had holes in it, although perchance we do. It was more a case of stop loss is so fundamentally critically important. And in fact, if you attend any of my trading presentations, I always say the reason I make money as a trader is not because I'm brilliant at technical analysis or brilliant at entries or anything else, but I'm brilliant at executing stop loss. Not the placement of, but when it triggers, I get out every single time. And I've been doing that for 14 years. It means I don't have those big losers. But with that, we'll hand over to Warren. As I say, you got questions, put them in the Q&A box. We'll pick them up as we go along. Warren, over to you.
Thank you, Simon. Good afternoon, everyone. As Simon says, stop losses have been spoken about many, many times. Fundamentally, I don't think they've changed much, but for those of you that might be totally new to trading, answer the question, what is a stop loss? It's a risk management technique to minimize losses in a predetermined manner. In other words, before we go into a trade, we know exactly what our expected loss would be. It can also be seen as the cost of doing business in the market. And as you would know, any business has a cost. And for trading, your stop loss is basically the cost of finding out whether you're right or wrong. If you're wrong, it's going to cost you this much. If you're right, you're going to make a profit. Obviously, stop losses can't be seen on their own in isolation. I haven't gone into detail with risk reward and position management and that kind of stuff, but they do have to be seen as a whole. Your stop loss obviously is a determiner of risk to reward as well as your hit rates. So to start off with, determining the stop loss value, it's a highly discussed topic in the field of trading and everybody has an idea of how it should be done. Every trader that you speak to, from the novice to the experienced guy, they have a view. The experienced guys have one view, and that is you have to have a stop loss. So I'm talking about the guys that are successful. When you look at funds that have failed, whether they are private funds or whether they're public funds or any sort of money manager, when they fail, it's normally because they didn't have a stop loss in there. So that sort of proves the point. There is no correct way of doing it. There are just a variety of ways from which you can choose. I haven't covered too many. Obviously, there's thousands of ways to do it, literally. So I've just taken some basic rules, put them down that you should be able to implement immediately. Personally, I believe that a combination of money management, in other words, a risk value, and the chart is the best way to do it. And that's obviously because I'm a chartist. As Simon was saying earlier, taking the loss means that you don't take massive losses when you should actually be going in the opposite direction. If you wait too long, you've gone long, you're still holding a bad long, then you exit at this big loss when you actually should be ready to buy the market. Okay, the idea is that if I take the loss, I'm out. When I get another signal to trade, I can trade again without any pressure. Basic rule, percentage of capital method. Now, there are many ways to do this. I choose a 2% of capital, and it's just a number at the end of the day. 2% of capital as a cash value for the stop. In other words, if your account is 100,000 Rand, your stop for each trade would be 2,000 Rand. This is then related back to the chart area, such as swing lows if you're long or swing highs if you're short. And I put together a little bit of math for you. It's not rocket science math, but it should give you a good idea of how I look at a chart. The entry price, 60 Rand 78. You can see the little green triangle at the bottom of the chart over there. That's a buying signal. The entry price is the next day's candle. Whether you enter at the open, obviously it's very difficult to get exactly the opening price, but somewhere around the open you're going to get into the trade. Your stop loss is simply the swing low, which is the red line down at the bottom. The value for that stop was 58 Rand 49 cents. Now, this is a daily chart. So in the evening you would have seen your buy signal, maybe early in the morning if you're like me and you're up at 5:30 looking at the charts. You'd see that come 9 o'clock when the market opens, you can enter the trade without an issue. You should already have decided what your stop loss is. the value of the stop loss would simply be the entry price minus the stop loss value, so 60 Rand 78 minus 58.49, and that gives me a value of 2 Rand 29 per share. That means if I take my 2,000 Rand calculated stop in cash, divide the 2 Rand 29 per share, I get the number of shares that I can trade in this particular position. That's just one way to do money management. It's position sizing, stop losses should go together. Take note that this would be an exposure of 53,000 Rand. If you were trading physicals, so you wanted to buy the physical shares without leverage, you would need 53,000 Rand to make that trade and live with the 2,000 Rand stop loss. Obviously, if you took half the number of shares, you would have half the value in stop loss. You'd only have 1,000 Rand instead of the 2,000 Rand stop. If you're trading CFDs, you had a 100,000 Rand account, you'd get 53,000 Rand exposure to Woolies, and it would cost you a margin of anything between 5 and 10,000 Rand in margin. And it shouldn't be more complicated than that. Just remember that your account leverage is important if you are trading CFDs. If you're trading physicals, the amount of cash that you have is important. You don't necessarily want to put 50% of your account value into one trade. All right. Example of a trailing stop. Those of you that know me or have listened to my webinars before will know trailing stops are my preferred way of doing things in most markets. It's very seldom that you'd find me trading for targets. This is African Rainbow Minerals. You can see there's an old short signal over there. A long signal came in on African Rainbow. It doesn't matter why it triggered, it just did. Entry price, again, the little green triangle there's on the doji. The next day market opens, you enter the trade, and I've got the risk reward ratio on the left hand side here. I've just put a 1 to 3 to give us an idea. Entry price at 185.50, exit price or stop loss value 176.51. That would be stop loss level 1 because that is the current swing low. When the market moved through the resistance level, so that would be that little engulfing candle there after the doji, the market moved through that resistance, I could have moved my stop loss up to entry price because at that point in time that would have been the current swing low. But what I did here just for illustration is I simply moved the stop loss to the high point over there. The market had broken away. 2 days later it had broken substantially. I don't have to take a stop loss at the swing low. In other words, I don't have to take the worst possible price available to me. The idea behind trailing stops is that I actually bank a profit. So if I'm wrong immediately, I'm going to get stopped out. I've managed the risk. I've got my stop loss at the bottom there at the swing low. I've entered. The market's moved higher. It's broken above. 2 days later, it's well above. There's good money in the bank. I don't have to then just leave my stop at entry. I can simply move it to the next highest level, and that would be this stop loss 2 level. African Rainbow continued higher. It started to hit a little resistance level, and you can see that was the risk reward ratio of 1 to 3. Look, I don't particularly believe in trading 2 risk reward ratios. In other words, if my target is 3 times my stop loss, I must get out. I don't really think that's a great way to trade. It is a good way to minimize profit. Okay, so I prefer to let the market tell me what to do. At that level, I can take a partial profit. In other words, I can bank some of the profit, I can cover all my costs, and maybe bank a little bit extra in case the market, as we know, can happen. We can have a big black candle, and we end up getting out somewhere close to entry anyway. So taking partial profits at a reasonable risk-reward ratio, not a bad idea, but I would like to leave something on the table for the market to go into a trend, which ARM did do, and we can see then that that low point became stop loss number 3. So we take a partial profit. You can either split it if you've got enough shares, so it's the number of shares is going to make a big difference. Whether you take 50% or 30%, that would be up to you and up to your account size. The market continued to move higher, then again broke a resistance level. 2 days later, it was well above that resistance level. You could have simply trailed the stop to that next level. So if the market does start trending, you still have shares in the market, you hold on to the trade. There's no hurry to get out of a position. Okay, the only time we get a bit concerned is when it goes sideways like this and we pay any interest. All right, for some of you know that as swaps. Okay, the market continues higher. At the orange circle, I get a bearish candle pattern. There's a bit of a shooting star over there. The market stays 3 candles sideways. I'm now in a substantial profit. That's nearly risk reward ratio 1 to 6. That's when I start to get a little nervous. Okay, we don't want to get nervous at entry and panic when the price drops a little bit. We want to get nervous when we've had a decent run. Market then starts to break down, and on breaks on that black candle over there. The next day we get bearish engulfing. In other words, it opened very high. It's called a failed break. It then closes down. I consider that a confirmed top. The next morning is the exit, and you can see there's the final stop. The market breaks through the next morning, exit the trade, bank your profits, and in this particular one, we got another trade the very next day. So we've just closed out of a long. We then get a short signal. Now, I know it's quite difficult the first time that you stop and reverse, but sometimes that's a really good technique. ARM is a bit of a swinging stock. Okay, so it's not necessarily a good, strong trending share that you can hold for 6 years. It doesn't really work like that. It's more of a swinger. So we would be looking to then enter the short. That exit price that we got for our long trade can now become stop loss number 1. In other words, I don't have to use the swing high. That was a support line. I'm now entering a trade that some might consider against the trend. So remember, your system must tell you what to do, which direction to be trading in. The trade goes in. The stop loss can simply become that old support area. Or if you're a little bit more, you can assume a little bit more risk, you could simply use the swing high. Obviously, it's a lot more in rand terms, so you take less shares for the trade. And ARM promptly fell down, made a couple of white candles there, giving us a little bit of a rattle, checking your nerves. And then yesterday closed lower. Today, by the way, it's somewhere down around 207. But the stop loss can now be moved from just above entry to the next swing high. So we use swing lows in an uptrend to trail the stops, and we use swing highs in a downtrend to trail the stop. If the market does go a serious distance from that low or high, we can simply move it to the alternative. In other words, in the uptrend, we can move it from the swing low to that little high point over there. When you get into good profit, we actually want to bank it. Here we're going short. The market swings up. That's my initial stop loss. I think after today, if ARM does close down at below 210, I'd start trailing my stop loss to that little low over there, just to bank as much profit as possible. There's a lot of people tell me you can't go broke taking profit. The reality is you can go broke if you don't take enough profit. And what you want at the end of the day is your trading system will have its own risk-reward ratio and hit rate. Okay, and that is different from your personal risk-reward ratio and hit rate. Systems are perfect. They go in and they get the exact price. Reality is, as traders, we don't get the exact price. Okay, we get slippage. If you're exercising your stop at the end of the day, and that is my personal preference for trading physicals or share CFDs, there's a high probability that the actual exit price will vary from the theoretical stop that we looked at on the previous slides. That is what slippage is. It's the difference from your perceived entry price to your actual entry and your perceived exit price to your actual exit price. And that slippage can be positive or negative. In other words, you can get, on the positive side, you can get a better entry, better exit. On the negative side, you get a worse entry than you wanted, or you get a worse stop than you wanted. This technique keeps your stop at a similar value for every trade. In other words, your 100,000 account, you'll always have around about 2,000 Rand as a stop loss initially. As the market goes in your direction, you're trying to bank those profits. As the market goes up a reasonable amount, you take off the first lot and you leave the second lot to run. The higher the trade goes in your favor, the tighter you can start bringing in your stops. A simple way would be at 3%, 5%, and then 10%, 15%, or 20% in your direction. 20% is reasonably rare, but if it happens, you really want to bring your stop up. I'd rather bank 19% than 17%. All right, so just remember, this is a way to keep it simple. The same value for every trade, and that allows you to easily calculate your position sizing. The next chart we're going to look at are different time frames. This is a question I get a lot. As a lot of you all know, I do coach traders, and confusing time frames is a big problem. Longer time frames require larger stops. If you use a weekly chart and you can go and have a look, a lot of our local shares, if you look at the weekly chart, the swing low is, on some of them, is actually the 2008, 2009 low. There's no ways that you're going to put your stop down there. You'd have to go down to a daily chart and use a current low somewhere. This technique can be applied to any instrument. So you look at a monthly chart, a weekly chart, daily chart. You can then go into day trading, where you can look at your 4-hour, your hourly, 15-minute, 5-minute charts. It applies across the it applies across the board. As we change time frames, the picture on the chart also changes. Now I've used the Aussie for this. It illustrates pretty good swings as well as these trailing stop loss ideas. The blue arrow is an actual trade short. The orange lines over here are nearby stop losses. So those two orange lines are nearby stop losses. That is the bottom of the gap from the open, and it goes across the body of that particular green candle over there. The orange line, the second one, is in the mid-range of the gap, but more importantly, it was a spike high. The red lines are alternative stops or faraway stops, top of the gap, and then of course the top of the swing high. Now, an hourly trader looking at this chart could easily have his stop at 250 points or even at the swing high at 520 points away. All right, so the time frame is quite critical. When we go down and we have a look at a 5-minute chart, those swings look slightly different. We can see the swings are not the same on a 5-minute chart. We've still got, I left the lines the same to illustrate the point. And we can see on the 5-minute chart that that little spike there is a shooting star. That can remain a nearby stop loss on a 5-minute basis. We now have two swing areas that almost form a double top, if you ignore the spike, of course. All right, so on the 5-minute chart, we're looking at between 30 points if you use the orange line, which is the gap low as a stop loss. Remember, the blue line was the entry. That was over here, so it hasn't stopped out yet. So you could use the 30-point level, you could use that swing high over there, or you could use the middle of the gap. The probability of a 5-minute trader, or I would consider the sanity of a 5-minute trader, using the red lines as stop losses, I think would be a little bit far out. That's a really long way away on a 5-minute chart. You don't need to take that kind of stop loss. You don't need a 500-point stop on the 5-minute chart. If I'm looking at a 5-minute chart, I'm thinking maximum 100 points. 130, I can push it to that. But 100 points is sort of the max I'm prepared to risk on a 5-minute chart. Money management should determine your stop loss value and thereby determine your position size. An added precaution for sizing should be that your account is not leveraged more than 3 times. In other words, on that example we looked at earlier, Woolies was a 53,000 Rand position. If you had a 100,000 Rand account, the maximum exposure you would want to take on that account would be 300,000 value. If you end up in a position where you had 500,000 exposure, that's just way too big for the account. In other words, the stop loss in isolation is not good enough. You also don't want to excessively leverage the account. Now, just to give you a little heads up, the Aussie, 500 points in the Aussie is 5,000 Rand. So if you were trading the hourly chart and you got a 500-point stop, as in that example, you'd need a 250,000 Rand account size to maintain that 2% risk tolerance. You can, of course, trade the All Me as an alternative, and you'd have a 500 Rand stop loss for the same 500 points. So you'd need 25,000 Rand account to trade that size. I'm not saying that you have to have a 500 point stop, but if you were, please make sure that your 2% risk is calculated in. There are always debates about the best way to execute your exit. Do we do it based on a close through the stop loss level, or do we take the exit real time? Both techniques have their benefits and drawbacks. They are mirror images of each other. If you're going to use the close of a candle, and this doesn't matter whether it's a weekly chart. If you trade the weekly chart, it would be a Friday's closing price. The negative of trading on the close, and of course if you're in a 5-minute chart, it would be a 5-minute close above your or below your stop loss. The close may be much worse than your expected exit price. In other words, I decide I'm going to close out at a 2,000 Rand stop, and by the end of the day, African Rainbow's gone right through the top there, and I end up with a 3,500 or 4,000 Rand stop loss. That's the downside of using the close. The positive is that you don't get sparked out. Now, how many times have you entered your stop loss into a trading platform, the price goes down, hits your stop, and by the end of the day, it's 2% in what would have been your favor, but you've now been stopped out at a 2,000 Rand loss. I prefer using the close. It's not that often that the price moves so far away from your preferred exit price that it's detrimental to your trading account. It might be bad on that trade, but if you're doing correct money management and you've got the correct position sizing in comparison to the risk of the instrument you're trading, it's not going to damage the business. The real-time stop loss, in other words, putting it into your trading platform, the negative side of that is you get sparked out a lot. And I just eventually got so irritated with that, you end up losing 30 trades when you should have actually made a profit on at least half of them. Okay, so that getting sparked out I found very irritating. If you are someone who is unable to watch your charts, in other words, you've got a day job, you're trading on the daily charts, but you are traveling in between, you don't always have time to update, you can consider putting the stop losses in the system. The downside of that, you're going to get spiked out. The positive, of course, is that your exit price is known. So you will always lose somewhere around 2,000 Rand. And the reason I use 2%, by the way, is simply you can use 1%, 2%, 3%, maybe even as high as 5%. But 2% is a nice one because plus cost equals about 3%. So I just keep it simple. It's 2% plus cost. Your trading system must have a definition for this item. Remember, trading system is made up of a whole lot of things. You can go and have a look at some of the other webinars we did on trading systems. The system must have a definition for your stop loss. Are you going to put it in the system, take it real time, or are you going to wait for the closing price? If you're day trading and you are trading on a 5-minute chart and you have to go out and your trade is in a profit, take the profit. Don't go putting your stop in the system. It's almost guaranteed to spike you out. Not because anybody's watching you particularly, it's just the way the market works. It has a vibration. It doesn't go up or down in a straight line. So if you have to go out, you're in a profit, take the profit. If you are in a loss, take the loss. Don't leave a 5-minute trade open. You never know when the traffic keeps you from getting back to the office. Here's just an illustration of the difference between having a stop in the system versus a closing price. This is exactly the same trade that we were talking about earlier. It's the hourly chart. We can see there's the little blue arrow, and a little bit dull. Couldn't get it bigger than that. But there's the little blue arrow for the trade entry. And we can see what happened today. The market has spiked through 3 times above that level. And at the time, or just before starting, when I managed to slip the slide in there, it was well down from its highs. And as Simon and I were chatting to go in, I actually got stopped out on a trailing stop as the market started to rebound. I have no idea what it's doing now. If you guys have any questions, you're welcome to email me or give me a call. Please feel free. Thank you, Simon.
Thanks, Warren. I can tell you the market is still bouncing, but still red. A couple of questions coming through, folks. If you've got questions, stick them in. Heather is asking me where I stop in terms of intraday or rather end of period or intra period. Now, I only trade on daily and weekly charts, and I stop on the daily or weekly, so end of. In other words, so yesterday, for example, on my Aussie trade, the market went into stop loss territory, but I wait for the close. Close happens, and I was by about a handful of points, maybe 60 or 80 points in, still above stop loss. Today it looks like we might get stopped out, but it was particularly that volatility. When I was trading on intraday on 5 and 10 minutes and stuff, particularly doing sort of a sort of reversal trades and stuff, I was a lot more aggressive. But in this point, aim of being lazy, I'm going quite simple on it. A couple of questions coming in. Gavin saying, why bank profits? The full profit is protected by the stop loss. Banking part of the profit limits future profit on the trade. Warren, I'm going to throw that to you in a second, but Gavin, let me give you my quick 5 cents. I don't bank profits in most examples. The only time I do is on my Aussie trading system, and that really is just the banking of profits does increase my profitability. So I will bank a third at either 1,500 or 2,000 points. If we move there very quickly, like in a matter of days, I'll wait for 2,000, more slower 1,500, another third at either 3,000 or 400, and then let the last third fade away. And it certainly, for example, I sold a third of my holding last week for 1,500 points. I'm going to get stopped today probably for maybe, I don't know, 1,200 points or something like that. In other words, I banked more money by selling. Warren, your comment on that?
I fully agree with you, Simon. Not all trades work out like that Rainbow Minerals one. Often a trade will get, maybe 5% on the underlying, take some profit there, and the next thing you know, you're stopped out at 3%. You've banked the extra 2% on at least a third or half of your position. It makes more cash than trying to hold an entire position all the way to the end of the move, because you obviously never know when that is going to be. And as Simon was saying, you just bank more money, trailing your stops and taking partial profits as the trade goes in your favor. And it also, it reduces the amount of stress that you have when a trade has, let's say, an underlying share has gone up 10%. That can be quite a bit of cash in your account. And guys get nervous and they grab that profit only to see the share go up 25, 30% like Steinhoff did. So I like to take some, and then it's a lot easier to let the balance run.
Yeah, and it's nasty. Particularly, I use a very lazy stop. I use a 15 EMA, and when the market runs quickly, that the stop is always rising, but the rate of the stop rising can often be slower than the rate of the market rising, if that makes sense. Yeah. So that stop can get quite far away from me at time. Warren, Raymond's asking your software package, OmniTrader, if I'm correct.
Yes, I use OmniTrader. I can program all my systems in there, and it fires signals for me every morning when I run the scan.
And folks can get it from you if they're interested. They can head over to your website.
Absolutely. They can give me a call. We can chat about it and make sure that it's something that they need.
Cool. Alan's asking, if the market goes greatly against you overnight, how effective is a stop loss? Alan, I'll give my 5 cents first. Look, if I'm long and the market crashes, I'm in trouble. But I mean, with my Aussie trading as well, I actually run a 1% rule for 2 reasons, or a couple of reasons, in case there's a massive overnight gap. Also because just in a sense, the profit still works nicely there. And also, as Warren says, because I use end of period, I might get slippage on my stop loss. So I enter at 1% and I might get out at 1.1 or something like that. I'm certainly comfortable with 2. Gaps overnight, they can hurt a bit. They're unlikely to cause really, I'm trying to think. I mean, we haven't had this year, I think we've only about twice had gaps of 150 points. Last year, maybe we had a dozen of them. And maybe the big ones were...
Yeah, we had some big ones last year. Eh?
Sorry?
I had an 800 point gap against me last year.
Okay, 800, because I was going to say, I remember the year before, I had about a 1,000 point gap against me.
There's been some...
Short answer, Alan, they can hurt. There's no bones about it. I, in part, manage it by using only 1% instead of 2. And it's just some of those scars that we get from trading. Warren, your views?
Yeah, I always use the example of Mittel. Yeah, they stopped trading 1 o'clock in the morning. The next time it opened was down 25%. Yeah, it's about a week and a half or 2 weeks later, or whatever it was. Now, how we mitigate that is position sizing. one trade should never be big enough to ruin your trading account. So if you spread your cash wisely, and you got 100,000 rand account, you can have 5, 6, stretch 7 very small trades. If metal goes 25% against you, it's not the end of the world for the account. So spreading the risk is a good idea. It's the same with if you trade the Aussie, you've got the gap risk. The average gap on the Aussie is somewhere around 150 to 180 points, but there are outliers out there. The worst one I've seen against myself was 800 points, but the average is a lot less than that, and it's very seldom that gap will hit you the day after you entered. So even though the gap is 800 points, you might not suffer 800-point loss. And the same with the shares. It's not very often that a massive move against you happens the day after you bought it. But metal is a really good example. Just keep your positions manageable.
And
always work out what is my exposure. So if my exposure is 100,000 on a share, the most I can lose is 100K. If you're happy with that, then you're at the right position size. So in other words, if that share goes to 0, you've lost 100K. If you're happy with that, then that's your position size. If not, make it smaller or bigger accordingly.
And sometimes those gaps go in your favor.
Oh, yeah. Those are wonderful.
Mark is asking if your stop loss is indicated as hit at end of day and by opening in the morning the price is above close, do you stay in the trade or exit anyway? I'll give my 5 cents. Mark, the way I hack it, so if I'm trading Aussie futures, I'm stopping on the top 40 chart. So top 40 closes at 5 o'clock because I use a daily chart. And then I would, if it stopped, the futures closes at 5:30, so I can immediately get out of the position. If I'm trading in my equity space, I trade indices, so I'm trading ETFs on the index, my process is that I look to action, I stop between 4:30 and 4:45. So I make a call. Are we at that point below my stop loss? So I action on the day. So it's not a case of close today and exit tomorrow. It's if we're stopping today at the close, I want to be out. Warren, your take?
I see what happens the next morning. There have been cases where I've stopped out only to see it go in my favor. Investec at the moment is one of those. Was closed out yesterday, short on Investec. Yesterday it went through my stop loss. It had closed just above it the day before. Yesterday morning it opened down and then moved through my stop. I then exited. In other words, I held while it was going in my favor. I held onto it. The minute it went through that stop loss, in other words, after the trigger, the day before it triggered, the day that I looked at it, it went through the stop loss real time, I exited. If it had continued in my favor, I would have probably held onto it. And it's always a dilemma. If I like to leave the market alone for the first 15 minutes to half an hour when a stop has been triggered. Obviously that can hurt, but generally speaking, it doesn't just move 20 rand against you. But ideally, the thing is triggered. You can check it the next morning if you've got time. If you haven't got time, just exit. 9:15, just go and close the trade. But if you do have time to watch it and you've got your charts maybe open on the side, you can just use that stop loss level as a real-time stop.
Raymond's asking best real-time trading software to use. Raymond, many of the stockbrokers offer real-time trading of varying degrees. I don't have a lot of experience with it. Or in your view, you use Velocity, if I'm correct.
Yeah, I use Terminal Velocity and I use OmniTrader real-time. The only reason, most of the platforms will come with live trading software. Yeah, I just use OmniTrader because it gives me signals.
Yeah, I think, Amy Broker also has it, but I haven't signed up for it. So you can give Warren a shout, OmniTrader, and he can chat you through that. Clive is asking, do you use a percentage trading stop or always a figure? Clive, I don't use percentage. I will use an EMA, which I think is a fairly dirty stop. It's got no nuance to it. Warren, do you ever just use a trailing percentage?
Look, I do. It depends again on the trading system. Some of my systems have stops. There's not a percentage stop, it actually has an exit signal. On my favorite one, which is the trend fishing one, I work on a trailing stop of 3%. If the market moves 3% in my favor, take off enough shares to cover costs, move stop loss to entry. If the market then gets above 5%, I'd like to move my stop loss to a 3% profit. If it gets to 10%, I want to move it to between 5 and 8% profit on the underlying share. So I do have a percentage trailing stop. And again, I don't think there's anything works better than anything else. It's what makes sense to you.
Yeah, 100%. Folks, we'll leave it there. We've hit time. Questions have run out. My thanks, as always, to you folks. I suppose a parting point for me is that stop losses are designed for 2 points. The one is to protect your capital. Nothing is more important. And the other point is to drive you crazy. The stop loss will at times drive you crazy. Don't for a moment stop it doing its first point, which is protecting your capital. Ladies and gents, thank you very much for your time. Warren, as always, really appreciate. Great presentation. Thank you.
Thank you, Simon. Pleasure.
This webinar was proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.